Hey everyone, welcome to this explainer. Today, we're putting on our scrubs and performing a rigorous financial autopsy on PayPal Holdings, ticker symbol PYPL. We're going to dive deep into the stark, uncompromising numbers to answer a really critical value investing question. Does a crashing stock price signal a dying economic moat, or is this a generational buying opportunity? If you love cutting through market hysteria to find true intrinsic value, well, you're absolutely in the right place. Let's look purely at what the financial data is telling us.
Okay, let's kick things off with a pretty staggering number, negative 81.12%. That's PayPal's total return over the last 5 years. I mean, think about that. If you had invested your hard-earned capital into this business half a decade ago, you'd have watched the vast majority of it literally evaporate. For a company that was once the undisputed king of digital payments, this level of wealth destruction makes most investors run for the hills.
But, seeing a collapse like that, a true value investor has to pause and ask the single most important question. Is the underlying business actually failing? We really have to figure out if the market is accurately pricing in a fundamental decline, or if this is just a massive disconnect between perception and reality.
All right, Section 1, the massive price drop versus reality.
So let's start by comparing the stock's performance to the actual real-world money flowing into the company, because honestly, it reveals a total contradiction. While the stock price has compounded downwards at a brutal 29% annually over the last 5 years, revenues have actually grown by 8% over that exact same period. It's wild, right? The business itself is getting larger, but the price tag the market puts on it is shrinking by nearly 30% every single year.
And this wild volatility really exposes the emotional swings of the market. Back in 2020, during the whole digital boom, the stock rocketed up 116%. Fast forward to 2022, and it plummeted by over 62%, with another 22% drop showing up for 2026. The market clearly doesn't know how to price this company smoothly. It's just swinging violently from absolute euphoria to outright depression.
Section 2, profitability under the hood.
Let's open up the hood here and look at capital efficiency. Because despite the spectacular stock crash, the fundamental engine is actually humming. Check out the return on invested capital. It sits at a really robust 22.46%, which actually beats its own 3-year average. In value investing, a business consistently generating over 20% on invested capital, well, that's usually the hallmark of a durable economic moat and strong pricing power.
And look, they aren't just efficient with percentages. They're generating massive, tangible wealth. Their trailing 12-month net income is over $5 billion. That's $5.059 billion of actual bottom-line profit. Make no mistake, this remains a highly profitable, cash-generating machine.
However, let's be totally fair and look at what might be spooking the market right now. Growth is undeniably decelerating. The 5-year revenue growth rate was 8%, the 3-year dipped to 6.3%, and the trailing 12 months, that's at 5.79%. For a market that's completely obsessed with hypergrowth, this downward trend line, which is likely fueled by intense competition from players like Apple Pay and Stripe, well, that's a major red flag for Wall Street.
Section 3, financial strength and stability.
Now, with slowing growth, the very first thing we do is check the balance sheet to ensure the company can weather a transition period. And PayPal is solid here. A debt-to-equity ratio of just 0.47 means they're incredibly lightly leveraged. Plus, their current and quick ratios both sit at 1.26. That means for every single dollar of short-term obligations, PayPal has $1.26 in liquid assets ready to pay it off. The bankruptcy risk here is practically zero.
Even better, their free cash flow yield sits at a massive 14.66%. To put that in perspective, at the current stock price, the company is generating nearly 15% of its entire market cap in pure free cash every single year. For a management team focused on smart capital allocation, this provides massive ammunition to aggressively buy back shares at heavily discounted prices.
Moving on to Section 4, current valuation multiples.
So how exactly is the market pricing all this stable cash flow? Well, the multiple compression we're seeing is staggering. PayPal is trading at a P/E ratio of just 8.47. Compared to its 3-year average of 15, the stock has been brutally re-rated. You're basically paying nearly 44% less for a dollar of PayPal's earnings today than you were just a few short years ago.
And it gets even more extreme when we look at enterprise value. The current EV to EBITDA multiple is just 5.49. That is a massive 60% discount to its 5-year average. The market is pricing this business as if its earnings power is about to permanently collapse. I mean, a multiple of 5.5 is usually reserved for declining, capital-intensive cigar butt businesses, not tech-enabled payment networks.
Literally every traditional value metric flashes bargain territory here. Price to sales is near 1, price to book is just 2.01. But the real standout? That's the PEG ratio, sitting at an incredibly low 0.44. In the investing world, anything under 1 is generally considered undervalued. Add in an earnings yield of over 12.6%, and the data is just screaming that this stock is on the clearance rack.
Section 5. The margin of safety.
This brings us to the ultimate question for any value investor. Do we have a margin of safety? This is a core concept popularized by Benjamin Graham and Warren Buffett. It's simply the gap between what a business is fundamentally worth based on its future cash flows and the current market price you actually have to pay for it today. It's your buffer against making a mistake.
Based on the discounted cash flow models from our source data, PayPal's calculated fair value price per share is a lofty $254.93. Now, as a rigorous analyst, you always have to remember that a DCF is highly sensitive to terminal growth assumptions. But hey, even if we assume a zero growth scenario, this mathematical target gives us an incredibly wide runway.
And because the stock last closed at just $45.23, comparing that market price to the intrinsic value creates a mathematical margin of safety of 82.26%. That is an absolutely enormous buffer against potential miscalculations or broader economic headwinds.
As this quote perfectly sums it up, there is a stark disconnect between market sentiment and underlying cash flow. Our autopsy reveals a highly profitable, cash-generating business armed with a pristine balance sheet that's just being heavily punished by pessimistic market sentiment. The business metrics point up, while the market metrics point straight down.
Which leaves us with one final, really critical question for you to ponder before making your next move. Is the market incredibly short-sighted, just panicking over a temporary drop in growth? Or are they actually accurately pricing in the erosion of PayPal's economic moat by those emerging competitors? The numbers tell us PayPal is a screaming bargain today, but it's up to you to decide if that cash flow will still be protected tomorrow. Thanks so much for joining me on this explainer. Keep digging into the data, and I'll catch you on the next one.